Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope you are incredibly well. No, your eyes do not deceive you. I am in the office. Why is that? It's because it's actually not Wednesday morning at Mortgages for Business. All staff have the option to work from home. It's the only day that we do. But it's actually Tuesday. I'm going to be leaving the house super early Wednesday morning to shoot off to a landlord event. So I'm recording this video a few hours earlier today. But let's not detract from the fact we've still got loads of really great content. It's right up to the minute still, so nothing's to be lost by videoing things a little bit earlier than usual, but I'm sure you'll forgive me for that. In terms of what we've got for you today, we're going to do our usual roundup of lender changes, talk to you a bit about what's been going on there. We had a new lender come in to visit us today at Mortgages for Business, who actually are taking a very refreshing approach to lending, which I'm going to share with you. We're then going to talk a bit about landlords exiting the market in this mass exodus that everyone's reporting in the news. We're going to talk a bit about that and what's actually going on there. Then we're going to talk about house prices, and lastly I'm going to talk to you about what I've learned thus far about the process of using a bailiff to evict tenants who simply will not leave your property. So lots of great stuff for you guys this week. Okay, now in terms of lenders, there isn't that much news this week because there haven't been many changes. There have been some changes. Why is there not much going on at the moment? Because swap rates are still stuck. So as of lunchtime today, 5-year swaps 3.935, 2-year swaps 4.431. So things just are not moving at all. Now we had hoped that with the base rate increase last week, we would see swap rates move down as the market gained confidence in terms of our financial policy and how we were getting to grips with inflation. The money markets didn't react in the way that we have seen them react in previous weeks. Whether they felt the move wasn't strong enough, I don't know. But actually the dip that we were hoping to see in swap rates didn't materialise, unfortunately. I think it's also worth saying actually, so 5-year swap rates are still 0.12% higher than they were a month ago. So for those of you who are watching swap rates or listening to these videos or other information, however you receive it, you know, after October, things were easing down. Then we had January, things got stuck for a bit, then they came down a bit, and actually we were hovering at sort of like 3.6-ish%. But then they started going back up, and we've been stuck really at sort of 4% or just below ever since. Now, there are some lenders who bought rates out when the rates were a bit lower and haven't subsequently repriced. What we've seen is a little run on lenders putting rates up this week. So what I'm about to tell you in terms of lender changing pricing, it's all upward movement actually, just looking at it. So there's nothing really to be read in this, I think. It's just that lenders haven't moved their pricing when their cost of funds increased. They're under pressure, and so they're having to now make adjustments. So what have we seen? So first of all, we've seen Paragon do two things actually. So first of all, they have increased their rates, only a little bit, but they have increased them nonetheless. Paragon were pricing incredibly competitively, especially when you consider the sectors where they operate. So limited companies, landlords with no maximum number of properties, but also no pricing difference between a standard property, an HMO and a multi-unit. So they had rates which were, an example would be, were 5-year fixed at sort of 5.3% with a arrangement fee of £2,495. You could get this at 75% loan to value on a block of flats of up to 20 self-contained flats, which people would ordinarily kind of link with more like commercial lending. So very keen pricing. Now, they've had to pull those rates, unfortunately. These guys are as open or as susceptible to increased cost of funds as the next company. So what have we seen? They've actually put their rates up a little bit, but they've also split out their pricing. So they now have a range of products for individuals and limited companies taking standard properties, and a range of products for individuals and limited companies taking HMOs or multi-units. So how that actually shakes out in the real world. So standard properties, your 2-year fixed rates are now from 4.8%. They do have a green offering in there. So if your property is not green's EPC of A to C, your 2-year fixed rate will be starting marginally higher. 5-year fixed rates from 4.9. Comparatively, HMOs and multi-units, 2-year fixes from 4.95, so 0.15% higher than standard properties, and 5-year fixes from 5%, so just 0.1% higher. So it's only a very marginal difference, but there is a difference nonetheless. So something to be aware of. Now, in terms of Paragon, I think I've really highlighted the key things that we use them for. So they've priced very well for larger HMOs and multi-units. They don't mind how many properties you've got in the background. They do need you to have income of £25,000 a year net of finance costs. They're one of the only lenders who have cottoned onto this at the moment. So most lenders just look at on your tax return. income on which tax is due, is it over £25,000, jobs are good and let's move on. What Paragon do is actually read further down the tax return and look at the finance costs, and then what they'll do is whatever figure is income which tax is due less finance cost, that equals your income. So just be mindful of that. So really solid offering from Paragon. Very sorry to see their rates increase, but actually understandable given the circumstances. Now we've also seen Lend Invest increase their rates a little bit, so they're currently at 5.48%. Put my teeth in. Foundation Home Loans, they brought out some new rates. Some have gone up, some have gone down. In the main, I'd say they're sort of fairly, the actual net effect is their pricing is fairly neutral. Their rates are now from 5.39. Now Paragon, Lend Invest and Foundation, all specialist lenders, all doing limited companies, HMOs, multi-units, all that kind of stuff. The only change we've seen from a standard sort of high street institution is called Mortgages, who have increased their fixed rates by up to 0.15%. So I'm really sorry that it's not rates coming down this week, but I think actually given the current climate and where pricing in the money markets actually sits, these are not unsurprising changes. I do think there's still room for lenders to kind of wriggle around a little bit in terms of their pricing, and it's a very strong chance that next week I'll be back saying, oh, so-and-so has brought their rates down. But this is really where we're looking, so things moving up by 0.15% and then things coming down by it. But until swap rates get unstuck, we're kind of where we are for now. I just wanted to touch on a lender that came to see us earlier on because I had a very interesting proposition. Now, United Trust Bank are a institution who have been in the industry for a very long time, largely focusing on development finance and more latterly bridging finance. However, they've also now entered into buy-to-let lending. And their proposition is very much that we're really good at unusual properties. Now, what they were saying to us is that they're able to consider things like houses next door to pubs, flats over takeaways, non-standard construction, so timber frame, concrete, that kind of stuff, the kind of things that a lot of lenders really shy away from because it's non-standard. And what they do, which is really interesting, is when they instruct the valuation, well, as a broker, if someone came to us and said, I've got a house that's 3 doors away from a pub, will the lender lend? We'll speak to them and they'll say, there's nothing in our lending policy that actually definitively excludes that kind of property. There's nothing there that says that we wouldn't lend. But really it's down to valuer's comments. If the valuer goes out, does their report and says, actually, because the property is 3 doors away from a public house, the reality is this property is going to be incredibly hard to sell on. There's going to be very limited appetite for it in the resale markets. The lender will then step away from the property. What United Trust is saying is that actually they're not going to ask the valuer for these kinds of comments. They're literally asking for valuation figures, sort of broad commentary around the condition of the property, whether it's lettable, if it's mortgageable, that kind of stuff. But what they're not looking for is resale commentary. They're going to take decisions whether they think it's something they want to take on board. So if you do have any properties knocking around where you found that it's been very hard to finance them because of the construction type, because it's very close to commercial, that kind of stuff, it's probably worth just keeping these guys in mind. The pricing is definitely on the top end of things. They're not the most expensive lender, but they actually are sitting at the top end of where things go. But actually what they're offering people is a solution which most other lenders may not be in the market for. So just one worth really thinking about. And at Mortgages for Business, we always applaud lenders who come in and try and buck the trends and do something a bit different and kind of disrupt things a little bit in terms of broadening criteria, opening the doors up for those landlords who may have been getting stuck otherwise. Shortly before coming to record this video, an article dropped into my inbox which had a headline that I couldn't ignore: the great sell-off, landlords quitting at highest ever level. Now, a couple of weeks ago we reported that Hampton has done some research. It noted that some 140,000 landlords sold buy-to-let properties last year because they had reached retirement age, and that accounted for 75% of all landlord sales in the previous year. So actually there is a lot of landlords selling off properties, but actually there's a really huge chunk. The majority of these are actually people who are retiring. Now, one could argue, do you ever have to retire from being a landlord? And of course, you know, it's not a passive income. That would be really unfair. But actually, it's not like you're going out and kind of shoveling bricks or something where physically you reach a certain age and you're not capable, physically able to continue doing so. But there are people who invested sort of circa 15, 20 years ago who always saw property investment as a means to save for pension income or an income in retirement or a sum of money in retirement. And these guys will have always maybe had one eye on potentially selling the properties when their retirement came to give them a lump sum to go off and do other things. So I think we have to be very careful when we read these sorts of headlines, because actually speaking to our clients who are landlords, the vast majority, of course they're fed up with things that are going on, of course they're annoyed with legislation and tax and all these other bits and pieces that are on the landscape, but actually the majority of them are very much committed to being a landlord. It's their job, it's their profession, they do it really, really well. And so their kind of position is very much, actually we just adapt, we change things, we don't always like the changes, but I mean, goodness, many companies actually do have to face changes. As a regulated company, we're always having changes thrown at us by the PRA and the FCA, and we simply learn to adapt to them. We don't necessarily like all of them. Some of them actually makes our lives harder, but fundamentally it's all part of running our business, and that's what we need to do. So I'm going to put this up. So this article that came out today, so what it is saying is the number of landlords planning to sell rented properties has reached its highest rate on record, and this is according to new data which was based on research conducted on behalf of the NRLA, the National Residential Landlords Association. And this data found that in Q1 2023, some 33% of private landlords in England and Wales said they plan to cut the number of properties they let out. This is the highest proportion ever recorded by this survey and is up from the 20% giving a similar response in Q1 2022, so year on year. By contrast, just 10% of landlords now say they plan to increase the number of properties they rent out. Now, interestingly, despite all of this, some 67% of landlords said demand for properties from prospective tenants was increasing. In every region of England and Wales, more than 70% of landlords said demand had increased, with the east of England recording the highest levels of demand. So it's very interesting that despite more and more people wanting your product, your buy-to-let properties, a huge number of landlords are thinking about at least partially divesting this year. Now, the NRLA have raised a very salient point in this report, which I just want to share with you. And what they've said is that the supply crisis is set to deepen further without action by ministers. It's calling for the government to undertake a full review of the impact of tax rises on the sector and develop new pro-growth policies. Now, interestingly, last night I spent an evening with the Landlords Association, and these guys are absolutely incredible. So for those of you who are landlords and who aren't a member of an association, I do think it's really worth considering, because these associations are the people that are lobbying with government, speaking to the housing ministers, speaking to MPs, and really trying to tackle all of these things that are coming to the light and are on the horizon for us all that we're facing, trying to kind of fight the landlord's corner. So I think actually as a collective, the more we can get behind these associations, the better. What they were saying is actually there is actually a kind of sense among government that they are maybe pushing things a little bit too hard at the moment, and maybe people need to take a step back, because the reality is the more you disenfranchise landlords, the more that sell up, the less property that's going to be available. And yet when they look at, and actually interesting, last month there was an estate agent who was there talking about this, the number of people who want to rent is increasing. Net migration has just topped 1 million, or will top 1 million by the end of this year. There are more people coming to this country who aren't necessarily going to want to buy, so the demand for buy-to-let is going to continue to increase. So actually all the government are doing by disenfranchising landlords is essentially deepening a housing crisis. So that's not great, but I think it's also worth, if you are one of the landlords who is thinking about maybe selling one or two off, and I think actually this is a really important point as well. The landlords who we hear about who are thinking about selling, they're not selling all of their portfolio. What they're largely doing is maybe selling a couple to take some equity to be able to pay down the mortgages on the remaining properties, so driving down their debt position to lower their financing costs. And this is in response to the higher interest rates, the increased tax burden as well. So I don't think there are many landlords, that are professional landlords I should say, who are looking to exit the market entirely. But in a moment I'm going to move on to a RICS report that just came out, and it's really, if you just keep in mind what we've just said with the NRLA report and then balance it up against the RICS report, you'll understand and see where things are really heading. Okay, now RICS have released their housing market report, which is really, really fascinating reading. And I'm not going to dwell too much on the actual housing market, but there's a couple of kind of key takeaways I wanted to share with you before we move on to the rental market. So the first thing they're saying is that actually it does appear that things have bottomed out, or at least steadying in terms of the housing market with regards to sale prices, demand and supply. So things are kind of reaching a much better kind of point than we have seen. What they're saying is that agreed sales for April returned to a net balance of minus 19%, which is up from minus 30% last month. And this also represents the least negative reading since July 2022. So actually things are looking better now than they did last month, and better than they did almost a year ago. They said that in terms of supply, survey respondents cited an overall flat picture for new instructions during April, with the net balance declining slightly from -4% to -4% from -6% in March. So in terms of supply, things have improved slightly. The recent decrease in demand and sales has resulted in a slight increase in the average number of properties held on estate agents' books to 36 homes on average for each agent, compared to 35 in February and March. There are slightly more homes available for sale per estate agency branch than there were in previous months. Now, they do say that looking ahead to the next 12 months, the price expectations indicator continues to improve from the lows hit during the end of 2022, returning a net balance of -16% in April compared to the -24% recorded in March. So again, things are expected to be much better or less bad, should I probably say, by the end of the year. Now, I'll go on to the home track version of this in a moment, because you always get lots of different kind of thoughts, but the sentiment actually is very, very similar, interestingly. I'm very used to reading lots of conflicting information, but actually these guys do seem to agree with each other, which is really, really nice, because I think all we could all do is some reassurance and certainty at the moment, couldn't we? Now, moving on to rental, which is the bit I'm really interested in. So meanwhile, in the rental market, tenant demand has increased in the 3 months to April, according to a net balance of plus 41%. So think about when we're talking about house sales, minus figures, rentals plus 41%. However, a fall in landlord instructions was recorded over the same time frame, with a net balance of -24 of respondents reporting a decline. So actually the number of landlords is, or properties coming to let, is reducing. The number of people wanting to rent somewhere is still very much increasing. So RICS have noted that the tenant demand continues to outstrip supply. Rental prices are anticipated to be driven higher over the next few months. They say the imbalance between demand and supply in the letting market still remains stark despite the significant increase in rents. Critical to addressing both areas of the market is the delivery of more supply. RICS are also increasingly concerned about the pressures facing the rental market. Demand for rental homes remains high, but stock remains low, and landlords are increasingly exiting the market, which is translating into higher rents. So nothing we didn't really know there. Now, moving on to the home track report. Now, I talk about this report often. I really like it. I think it's very, very good. So key takeaways from their report. So like I say, a lot of a theme here. Annual house price growth slows, but the worst of the month-on-month falls are behind us. Demand continues to recover as the number of new sales grows. 3-bed homes remain the most in-demand property for first-time buyers, 40% of them in fact, but there is also a clear shift in first-time buyer demand towards 2-bedroom flats. The thought process behind that is that because of affordability challenges with higher mortgage costs, first-time buyers are saying, do you know what, I can't afford the 3-bedroom house, I'll go for the 2-bedroom flat instead, and that's kind of what's driving that. Also, people are much more mindful at the moment of running costs of properties. Obviously, generally speaking, it would be much more cost-effective to heat a 2-bedroom apartment rather than a 3-bedroom house, so just something to be aware of. The income required to buy a 3-bedroom first-time buyer home has increased by £7,350 since 2020, but this does vary by geography. So that's really just illustrating, because of the higher house prices, but also more onerous stress calculations, income calculations that lenders are using on homeowner mortgages, your average first-time buyer to buy the same house they would have bought in 2020 now needs to be earning £7,350 more than they would have done. Okay. So they're now talking about sales. So our leading indicator of housing market activity and pricing show a steady and sustained recovery in demand and continued growth in the number of new sales agreed. House price inflation continues to slow, but a major price recorrection remains a very low probability, i.e. they're not expecting things to fall off a cliff. It's kind of very, very slow downwards now, but actually what they're expecting is things to go up. And this is what they say going at this point here and in. Annual house price growth has slowed to plus 3%, with prices continuing to register modest quarter-on-quarter price falls of minus 0.7% across all regions and countries of the UK. There are early signs that the level of monthly price reductions are now reducing, and the main adjustment in pricing is behind us. Our UK index is likely to register low negative annual growth by the summer, and at the end of the year will finish at minus 1%. Do you remember the headlines that were talking about minus 20% on property prices? It looks like we're going to get nowhere near to that point, thank goodness. Now, what they go on to talk about is the outlook. So the worst of the pricing adjustment in response to higher mortgage rates appear to be behind us. House price growth will slow further over 2023, dip into negative territory. More important is the fact that transaction volumes continue to grow. The housing market is arguably more balanced now than it has been for some years. It's clear that there is a range of demographic and social factors continuing to motivate households to move home. If sellers continue to be realistic on pricing, then there is a chance for up to 1.1 million sales in 2023, which would be a very positive outcome. So there you go. So I think what we can really take away from this is two things. So first of all, house prices, the fall will continue towards the end of the year, but the net position is we're going to end on a 12-month comparison at just minus 0.1%, which actually is quite a small reduction. In terms of that point onwards, they're going to be expecting things to then start to recover. I don't think there's going to be any great hallelujah moment. It's going to be a slow recovery, but a recovery nonetheless. In terms of rent, there are landlords exiting the market, be it because they're disenfranchised, be it because they're just looking to kind of reconsolidate things, re-level their cash flow situation, or they're just simply retiring, which means that less buy-to-let properties are available. There are more and more people looking to rent properties, which is really starting to push up rents quite aggressively. And I think that probably summarises the housing market in a nutshell for the time being. Lastly, very quick one. So the saga of my getting my buy-to-let back. So Section 21, I served that on the tenant. Went to court, the judge gave them till the 9th of May to move out. They didn't move out. We've now applied for to the courts for a bailiff to arrange an appointment to go and evict them. That's weird in itself, isn't it? Now, I was chatting to the solicitor who's acting for me, and I just found it quite interesting because I've never gone through this process. Thankfully, this will hopefully be my last time as well. So what they were saying to me is that essentially I applied to the court for one of their bailiffs to go and take possession of my house. What they'll do is write to the tenant and say, just so you know, we're coming around to evict you. They then turn up on the day and they will enter the property, and they will not leave the property until the tenant vacates, which, just imagining it in my mind, would be incredibly awkward. What they were saying is that on the day of the bailiff's appointment, I or my representative, in which case it will be the letting agent, needs to turn up 15 minutes before. We need to have arranged a locksmith to be on hand to change the locks. So I think what happens is the bailiff literally enters the property and then waits until the tenant vacates. I have to be honest, I'm glad I'm not going to be there because it sounds incredibly unpleasant. These bailiffs must just be, you know, such brave people. But that's kind of where we are. So the likely waiting time for my bailiff to be kind of instructed is 4 to 12 weeks. So yeah, we're just going to wait. I'm just going to carry on waiting. But that's where we are with that. And that's me for this week. Thank you so much for joining us as always. I hope you found that interesting. Lots and lots of data in there, but I do think this kind of stuff, particularly in a time where things are very, very unsettled, and there is a lot of kind of headline grabbing news stories around. I think it's always quite interesting just to sort of delve into the data and try and really understand what's going on so we can make our own minds up about where we think the market's going to head and what we should do for our next kind of decisions. If you have any questions, we'd love to hear from you. 0345 345 6788. Or as always, there is an abundance of information on our website. Have a wonderful week. Have a lovely weekend, and I will see you again same time next week.